good morning, good afternoon, and good evening to in-house counsel and in-house legal professionals from all across North America and the world. Welcome to In-House Connect. I'm Shai Mahani. I'm the CEO and co-founder of In-House Connect. I'm thrilled to have you here with us today. Thank you for spending your breakfast time or your lunchtime with us. And special thanks to our wonderful sponsor. This is a co-sponsored event, we could say. Hilgers Graben and In-House Connect are sponsoring this. And of course, big thanks to our wonderful presenter, Sterling Miller, the man, the myth, the legend. I'm looking at them. Prolific writer, author, speaker, and we're thrilled to have him on with us today. This is our 48th webinar of the year, and I'm wondering, are you here for the first time or have you tuned into an IHC webinar before? We're thrilled to have Sterling Miller on with us today. He is the CEO and senior counsel at Hilgers Graben, a nationwide litigation boutique law firm. He has had a long and storied in-house career. He's a three-time general counsel. He was at Marcato, he was at Sabre and Travelocity, and he was at I think he worked at American Airlines as well in-house. I remember reading about that. He has a phenomenal blog called 10 Things You Need to Know for In-House Counsel, and it's just phenomenal. I'll share links to that as well, and he's a wonderful follow on LinkedIn as well. So thrilled to have him. Again, prolific author. Sterling, when you have a chance, tell us more about the book that you're going to give away and how we're going to do it. But until then, I want to turn things over to you to get us started. But it's just a pleasure to have you on as always. So thank you for taking the time today.
Wow, what a warm introduction. Thank you, Shai, and excited to be back. I love In-House Connect, all the programs that you do. I sign up for so many and then I get to see some, but I also have a lot I have to watch. I'm trying to catch up slowly. I appreciate the legend comment. I think about that when I'm cleaning out the cat litter box, that this is what legends get to do with their lives. So just a normal guy with a blog. And I thank everyone who reads the blog or reads the books. I never imagined I would still be doing this after so long, but it's a lot of fun. And we're going to have a lot of fun today because this is a topic where my expertise is minimal, which I suspect is true for a lot of people. I had to learn this the hard way, and we're going to talk about, like many things I write about, how I failed and then how I figured out how to make it happen, how to actually learn something that I didn't want to learn and was not very comfortable with. As Shai mentioned, I've been doing this for a while, been a lawyer for over 30 years. You will get a copy of the presentation. All the hyperlinks will be live. There are a ton of resources at the back. There's an entire appendix of things that I'm just not going to be able to get to, but you'll have a chance to look at those. And I'll also say my email information will be at the end. If you have a question, you want to ask me something, just reach out, connect with me on LinkedIn, send me an email. Love talking to in-house lawyers, never a bother. I am one of the few in-house lawyers that was drugged back into the law firm world. I actually really enjoy it, though I do think being an in-house lawyer is still the best job in the world, but I am the CEO and senior counsel, so I still do some legal work for Hilgers Graben. We are the largest female-owned law firm, I think, in the world. We have 144 lawyers scattered across the country. And that's all I'm going to say about that. This isn't a sales pitch, but if you do want to learn something about the firm, just reach out. Happy to talk to you about that as well. I have written 6 books, and as Shai said, at the end, we are going to give away a copy of the newest one, which came out the latter part of last year, The Productive In-House Lawyer. This is where I've written about all the different ways that I have found to be more productive in doing a job that doesn't lend itself to productivity, and that's being a lawyer, and in particular, being an in-house lawyer. So how do you get more done with the time that you have allotted? So we'll do that during the Q&A. You have to be present to win. So if you have to leave, I'm sorry, but you have to be on at the time we give the book away. The most popular book, I wish it was one of the legal books, and I wish it was the football book, but it's actually the cookbook, which is a surprise to me. Such a surprise that I am writing volume 2, which I was telling Shai earlier will be out later this year. So if you're interested in slow cookery, I'm your guy, and these are your books. But enough about that. Let's go ahead and jump into why we are here. So let's do our first poll, Kate. I want to get a sense of how comfortable people feel they are with numbers. So if you could pop that up, that would be fantastic. And if you can't, just let me know and we'll keep moving along.
I don't believe I have the power, but Shy should.
There we go. Okay, I'll ask Shy then. So first poll, what's your comfort level with business finance? Is it high? Is it medium? Is it low? Or is it super duper low? A whole new level of low. Looks like medium to low, but not a surprise. If it was high, you probably wouldn't be on this presentation. That's not unusual. This distribution of scores, I would say most people feel uncomfortable with business finance. I know I certainly did, and there's a reason for that. And that's what I'm going to talk about next. So let's go on to the next slide here. So I call this Don't Be a Tourist. When I went to law school, there was no math, which was fantastic. I was very happy about that. I remember accounting from being an undergraduate. I can remember sitting in the room. I can't remember anything else about accounting other than I was present. And I think I got a B, which probably was what everybody got who wasn't going on to be an accountant. And when I was at a law firm, there was a little bit of math, not much. I was on the litigation side, occasionally on damages stuff, you would see it, but not enough that I really felt I had to spend a lot of time on it. But when I went in-house, everything changed. And I realized pretty quickly that accounting and finance and numbers, those are the language of business. And that's what I mean by being a tourist. Tourists are people who don't speak the language, right? They're visiting, they're not natives, they're there for a little while, and then they move on. If your goal is to really become part of the organization, to really be sunk in deep with your business colleagues or the leadership team, if you're working your way up to the top, you need to understand and you need to learn the language. That means you're going to have to learn math. The other reason it's important is it's really difficult if you're advising the business and you don't understand the math side, how the business operates and what the numbers are, because that's going to have a real impact on the advice you give, either from a corporate side, from a litigation side, intellectual property side, whatever the type of legal problem that you're trying to solve or whatever advice you're trying to give. Understanding the financial situation of the company is going to be important in order to make that advice more than just legal advice, to make it strategic, to make it practical. So there's a lot of reasons why learning the math is going to be important. And when this really dawned on me for the first time, I was general counsel, my first day as general counsel at Travelocity. And there was a C-suite meeting, and I'd go in, and there's all these spreadsheets up on the screen, and they're talking EBITDA, they're talking CAGR, but everything was flying over my head. And I could have raised my hand and said, could you explain what EBITDA is? Could you explain what CAGR is? That probably would have been not the smartest move that you could make. So I didn't, but I did start to keep a notebook, and I would write down terms, concepts, anything that I didn't understand. And then I would go find someone to help me understand it. I had a lot of friends in finance, and I would just go ask them, what does this mean? Why is this important? And eventually over time, I learned enough things that I became pretty comfortable when they would throw the spreadsheets up and the charts up and the graphs up that I could follow along. I still have this notebook. It's somewhere around here in the office. I still use it because it's like a foreign language. If you don't use it a lot, you tend to forget things. So you try to refresh yourself on it. But today, we're going to talk about really just the basics. And hopefully, by the time that we're done, you're going to be able to recognize and maybe even navigate some of the most common finance issues that I think you're going to face as an in-house lawyer. Will I become an expert today? No, you will not. I'm hoping you're going to understand some of the basics of the financing or of finance, or maybe where do I need to go? What areas do I think I need to improve on? And then where can I go to get more information? There are some resources in the back. As I mentioned, all those hyperlinks will be live. One of the best places you can go. How do you read a balance sheet? How do you read an income statement? I went to YouTube and I just YouTubed Ivy League professors' financial statements. And there were recordings of lectures from Ivy League schools where the professor is just walking through how you do these things. And there are tons of those. They're easy to understand. You can keep going back to them as many times as you need. So you can find those resources out there that can help you understand a lot of the things that we're going to talk about here. And hopefully, when we come out of this, you're going to be a little more confident at least, and maybe you'll move up from low to medium. So first thing we're going to talk about is GAAP. And I suspect a lot of you have heard this term, but maybe don't understand exactly what it is. GAAP stands for Generally Accepted Accounting Principles. There's this group of finance nerds called FASB, Financial Accounting Standards Boards. These men and women sit around and they come up with the rules for accounting. How are companies going to use accounting tools and methods to track the finances necessary to show how companies, businesses, or whatever the tools may be used for, how are they going to do that? But GAAP is really important if your company is publicly traded because it's required. You have to report your finances in GAAP following the rules. And it's one of several ways that investors can feel really confident that the numbers that they're seeing are true. If you're following the GAAP principles, then there's credibility behind the numbers. And those financials, those GAAP financials, if you hear about your company being audited, and almost all companies of any size have an auditor that comes in once a year and just checks the numbers, that's a good thing. You want to see that, make sure everything is ticked and tied. It's just another way, again, of providing an accurate picture of the financials. If you're old enough, like I am, you might remember a company called Enron, which was they were finding ways to game GAAP by moving numbers, taking advantage of things that weren't necessarily super clear or maybe were flexible, quote unquote. And that is the genesis of something called Sarbanes-Oxley, at least here in the US, which was a law passed a while ago to require certain heightened expectations on the CEO, the CFO, anyone involved at the numbers of the company to make sure that those numbers are correct. And all of that ties into GAAP. If you are international, and I realize there are several of you at least on this now, there's a standard called IFRS, which stands for International Finance Rules, something like that. They have their own accounting board, IASB, and there have been efforts over time to get GAAP and IFRS to be the same. There are some differences. For the most part, the things that we are going to talk about today, it doesn't really matter. They're close enough that it's not going to be a big difference. If you hear about companies using non-GAAP measures, and a lot of times you'll see this when you get to the quarterly reporting of companies. If you've ever sat through an analyst call where they're talking to the numbers, a lot of times companies will say, here are the GAAP measurements, but we also have some non-GAAP measurements that we think are important. And why do companies do that? They do that because there are things that are happening with the finances of the company that they believe are not part of the typical finances of the company. They're one-off events, they're special events, they're extraordinary events, and they're asking investors to what they call look through those numbers to this non-GAAP measurement, which the company thinks is a better representation of how the company is doing financially. So even if under GAAP, the company may be showing it's losing money, the company is saying that's really not the way you should look at it. This non-GAAP measure shows us actually being profitable. It's pretty well accepted that if there's a good basis for doing that and you can justify doing that, it doesn't excuse you from reporting under GAAP, but it allows you to talk about the company in a way that is different than how it looks under the GAAP standards. Now, what you want to watch out for and what investors watch out for and regulators watch out for, you can't have 20 non-GAAP measures. Maybe you're going to get one, two, or a handful, right? But the more non-GAAP measures that you're trying to sell, so to speak, to the investors, they're going to start being very suspect about the numbers that you're trying to present. But if you hear about non-GAAP, that's really what they're talking about. They're talking about something special or extraordinary that they want you to look through that even under GAAP isn't giving you the accurate picture of the company. Okay, so let's do our next poll. Shai, I want to get a sense for how many of you can read a balance sheet, an income statement, and a cash flow statement. So can you put that poll up? There it is. I can read a balance sheet, cash flow statement, or income statement. Let's see what we get. We get we get some yeses. That's great. We have
Sure.
some no's.
Somebody, someone,
We have some what are you talking about? That's great. Yep.
someone in the chat is asking, could you share one common example of non-GAAP measures?
Yes. If you have, this is one that we used when I was at a company. We had some major antitrust litigation, which was, in my opinion, and I was able to convince the finance team that this is such an extraordinary cost to the company. These types of cases are so rare that you should take those costs out of the analysis of the finances of the company and look through that. We would still use the normal legal budget and kind of the normal type of litigation, but those one cases should come out, and you took out those millions and millions of dollars that we were spending on antitrust litigation. The numbers of the company look a lot different than when you put that into the finances. It's looking at extraordinary, very rare events that you don't think are recurring and are a fair representation of the business. So that's one example that I was actually involved in. Okay, so let's look at our distribution. Yes, okay. 15%, about 20% no, over half. Yeah, that's where I've been. And a small percentage aren't really sure what I'm talking about. So let's go into what this is. There are two ways that you can keep track of money. One is on a cash basis, which is how you live your life normally. You get cash, you pay cash, you track your checkbook or your bank accounts. That's what you're doing. That's a cash basis. The other is something called the accrual method. And that's what most companies use, because unless you're fairly small, tracking cash in and cash out isn't an accurate reflection of how the company is doing, because it postpones recognition of revenue and it doesn't match the costs of generating that revenue in the same period. So the answer to that problem, which was something that was developed a long time ago, is called the accrual method. And the accrual method, the revenues are recognized in the period in which the transaction occurs. And the costs, the expenses that help generate that revenue, they are also recorded in that same period. They are what is called matched. So the expenses that are required to generate the revenue are all recorded in the same period, regardless of when you get paid by the customer and regardless of when you pay for that expense. It's different than cash. It's based on what they call accruing the revenue and accruing the expense. So it's irrelevant when cash is paid out or received, which I know feels counterintuitive, but this is the method that actually more accurately reflects how the company is doing. And this originated with something called double entry accounting, which was invented, I think, in Italy by bankers in Italy 500-600 years ago now. And the whole principle, the way that I tried to keep this straight in my head, is you're tracking money based on when things happen versus when you get paid or when you pay. So what happened in the business that's going to generate an accrual for revenue or an accrual for an expense. And if you can keep that straight in your head, it'll go a long way for understanding why accrual accounting makes more sense for most companies than being on a cash basis. Now we're going to get to the statements. So there are three core statements that you need to be at least familiar with, because all businesses have these statements and they are important to understanding the financial health of the business. I call them the big three, and they are the balance sheet, the income statement, and the cash flow statement. The balance sheet is a snapshot in time showing what the company owns, what it owes, and what's left over, which is called owner's equity. And there's this very basic equation. Probably the first, if you take an accounting course, one of the first things you're going to learn is assets equals liabilities plus owner's equity. Assets are things like equipment and cash, buildings, things that the company owns. Liabilities are, you got to pay back a loan, salaries for your employees, interest payments, accounts payable, taxes. Owner's equity is what's left, right? What's the difference between the assets and the liabilities? That is what the stockholders technically have a claim to for the company. It represents the book value of the company. Now, you got to remember, book value is different than the market value of the company, because the market value is probably going to be significantly higher than the actual book value. It could be because of intangible things like a great brand name, great customer loyalty and retention. All of those things would cause someone to pay significantly more than the book value to actually own that business. That's the market value. The book value is really just the numbers that are in the financial statements. But the balance sheet, you're just looking at a snapshot. Here's a sample one. We're looking at the end of the year. You can see on the left-hand side, these are all the assets, things that you would expect: cash, inventory, investments, property, intangibles, which would be things like patents, other intellectual property assets. And so your total assets are on the left-hand side, little over 470,000. Your liabilities and shareholders' equity, accounts payable, notes payable, deferred revenue, debt, and then your shareholders' equity, your stock, retained earnings, treasury stock, all of that should balance. If it doesn't balance, that tells the finance people something's off somewhere, and they have to figure out at the end of the day, it should balance out. And this will tell you, if you're looking at this sheet, a lot about the company in terms of what liabilities it's undertaken and what assets it has. This is a very simplified version of a balance sheet. If you work for a publicly traded company, if you go to the annual report or the quarterly reports, you will see a balance sheet in there in the financial reporting. It'll look somewhat like this, but all businesses have different things that they put under the categories of assets and liabilities, but you'll be able to follow along pretty much along the lines of what we're talking about here today. The second of the big three is the income statement, sometimes called a profit and loss or a P&L. So if you're sitting in a meeting and they're talking about the P&L, they're talking about the income statement. And what this shows is how profitable the company is over some measurement period. Could be a quarter, could be a year, could be a week. There's no real limitation on what it is. It's just over some period. And it shows you two things: revenues, so money's in, and expenses, money out. Very simple formula. Your revenues minus your expenses gives you your net income. Hopefully that number is positive, right? Because if it's not, that means you are losing money, or at least you lost money during this measurement period. And what are revenues? What is your company's business model? What are you selling? What are you offering? What are you getting paid for? Those activities comprise the revenue part of this equation. And under the accrual method, as I mentioned, revenues are recorded when they are earned, not when the money is actually received. So if I sold something today, even if I'm not getting paid for a week, that's going to be considered earned later. Expenses: what did it cost us to produce those revenues? Salaries, rent, cost of materials, advertising, electric bill, all those things are going to fall under expenses. Similarly, under the accrual method, it's when they are accrued versus when the company actually pays for it. An income statement is a great way to kind of look at how these things are matched. If you agree to deliver 100 widgets in May for $1,000, that contract is signed today. That revenue, that $1,000, is recorded today in May, even if the customer isn't going to pay you for another 6 months or 80 days or whatever the terms are. On the same day, you hire a vendor to deliver those widgets to a customer in May, and you don't have to pay for that until June. So the cash isn't going out the door until June, but you incurred the expense in May. So that expense to deliver the widgets, that is matched up. And that is really the fundamental premise behind accrual accounting, trying to match the revenues and the expenses. That net income, that difference is what's called the bottom line. You may hear that term. It's different than below the line and above the line. Net income is a kind of a proxy for profitability, and you may see financial analysts looking at multiples of net income if they're trying to compare businesses, if they're looking to buy a business, sell a business. What are the multiples of net income of comparable companies? That gives you some idea of what the value of your company is, or the value of the company that you may be trying to acquire. If you are in the legal department, you do have a P&L, and you need to pay attention to that, especially if you're a general counsel, because people will be watching your P&L very closely. It's mostly money out, right? Because legal doesn't necessarily generate revenue, but primarily they're just looking at what the expenses are. But there is a revenue, there is a P&L for the legal department in most companies. And this is what the income statement looks like. So revenues, all those things we just talked about, $653,000. All the expenses that are going to get backed out of that, the cost of goods, selling expenses, G&A, general and administrative, that's where legal sits. These are administrative expenses that the company has to bear just to keep the lights on, so to speak. You have your income before taxes, and then your income after taxes gives you your net income. So this is what they're looking at in an income statement, and this is measuring the entire year. You could do this by quarter. You could compare first quarter of last year and first quarter this year. There's a lot of different things that you can do with the income statement. So it's a pretty important document, one of the big three. Cash flow is something I think is really familiar to most people. And what this shows is actual cash in and actual cash out. So this is very different than accruals. This means you're actually getting paid, or you're paying money out the door over whatever your measurement period is. Your cash can be from getting paid, investment returns. If you're financing, if you get a loan, that all goes into cash. Cash is important because, unlike accruals, which you think are giving us an accurate reflection of how the company is doing financially, if you don't have cash in the bank, you can't pay your bills, you can't pay salaries, you can't keep the company going. So it's really important that companies have an appropriate cash balance, operating cash, so they can pay their debts. A lot of companies, because cash can be lumpy, they'll have what they call short-term loans with banks called a revolving line of credit, and they can borrow from that and then pay that back as soon as the cash starts to come in. That allows them to manage the cash flow needs of the company. If the cash isn't coming in for too long of a period of time, that tells you that the company may be in trouble because it's not able to collect, it's not able to generate cash from its activities, and that potentially is a problem. Cash is another way that you can measure the value of a business. You can look at its discounted cash flow. You can look at just how much cash it has on reserve, what you would do with that cash if you bought this business. So there's a lot of value to understanding what there is in terms of cash. And here is a very simple cash flow statement. So you're just going down the year 2017, 2018, 2019, 2020, and it's cash in, it's cash out. And you can see in this example, in 2017, the company lost money, but that's okay, depending on where you are, or maybe you have other plans for the company. So now you take that negative balance and then you go through the company's activities, and you can see this company year over year has been dramatically increasing its cash flow. It's almost double each year. It varies a little bit. That's a pretty healthy business where it's actually starting to double the cash that's coming in the door. So if I'm looking at this cash flow statement, when I'm trying to get a sense for how healthy this company is, I'm looking at two things. One, it has a lot of cash and it's generating cash. That's great. Where is that cash coming from? And you can see here, it's not coming from sales of assets. It's not coming from loans, so they're not borrowing it. And it's not coming from having new investors, that capital coming in. It's almost exclusively coming from sales, meaning the business is growing. So this is a very healthy cash flow statement. And this tells me a lot as an owner of the business or someone looking at it from the outside, that this is a business that I'm going to want to probably invest in because it's having a lot of success with its operations. The general ledger. So the general ledger is the Bible of the finance team. Every transaction, money in, money out, investments, expenses, everything is recorded in what they call the general ledger. And these general ledgers can have thousands of different classifications. It just depends on how granular the finance team wants to be, how granular the C-suite wants that information, or the board. So some general ledgers can be very short, some can just go on and on. In the appendix, there's some examples of that. But those three documents we just talked about, those numbers come from the general ledger. So those assets will be pulled out of the general ledger. Those expenses will be pulled out of the general ledger. What cash is coming in is all coming out of the general ledger. So you can think of the general ledger as the center of the universe when it comes to the finances of the company. All right, so what are some key terms? So we've talked about the key financial statements. We've talked about GAAP, accrual accounting, the general ledger. So what are some of the things that if you're sitting in a meeting, you're most likely to hear as an in-house lawyer? The first one, at least in my experience, is something called CapEx, which is capital expenditures. And what they are talking about there, CapEx refers to funds that the company is using to acquire or maintain physical assets, such as property, buildings, technology, equipment. It's used for investments. It's the type of expenditure that the company has to make to grow or at least maintain its operations. And what it typically does, it's not, hey, I'm going to go buy a laptop today for Joe in accounting. It's, we're going to build a building. We're going to go buy something significant. We're going to outlay funds over a significant period of time. And because you're doing that, it's not treated as an expense on the income statement. It's an investment, so it becomes an asset. It's capitalized on the balance sheet. Now, do you need to know everything there is to know about that? No, I'm just telling you that's what the finance people are thinking about when they're talking about making a capital expenditure. Why does that matter? So it's a long-term investment. It's capitalized, meaning, again, it's added to the balance sheet. It's an asset, and then it's depreciated. So that asset over time loses value as an asset, and depreciation shows in your balance sheet the decreasing value of that asset over time. The examples, again, building a new plant, maybe getting a new IT system for some reason, and you report this as an asset. Over time, it's depreciated, and then in cash, it's recorded as an investment. It's investment activities. So big capital expenditures are going to touch all three of those documents. So let's have an example here. Say you're going to build a new warehouse. So your initial outlay is $3 million. You're going to purchase land. You're going to build a building. You have to buy fixtures, office furniture. All those things have to go in to this new warehouse or store, whatever we want to call it. So you have the $3 million recorded on the balance sheet. You're going to depreciate that expense over time on the income statement, and you're going to show an outflow of $3 million on the cash flow statement as an investment. Capital expenditures, the easiest way to think about it, it's something big. It's going to get paid for over a long time, and then it's going to be treated differently than regular everyday expenses. That's pretty much what you need to know about CapEx. The next one, let's do a poll. We're going to talk about EBITDA. So pick that one.
On assets. So there were a couple of questions there. One was, do you see tech companies valuing data and the rights to it as an asset?
Wow, I have not seen that, but I think that would be an asset if you can value it. Certainly, if you're selling data, data is going to be an asset. So if someone has a different viewpoint and you want to weigh in on the chat, go ahead. But I haven't seen that, but I think the answer would have to be yes.
Great. And then another question that we got was, why is deferred revenue a liability and not an asset?
I have no idea. I would have to go back and refresh my memory on why that is. I probably knew that at one time. I do not know that as I sit here. Okay.
Fair enough.
There we
It's very
go.
important. This is a great example of admitting
Yes,
when you don't know something. That
that's
is
right. You
important.
don't know.
And then just one more question we have, which
Yeah.
is, does CapEx have to be for a physical investment, or does a tech platform count?
The platform would count. If you're building in like an IT platform, yes, it would. If you're talking about something different, I'm not sure, but I would need to know what you're thinking of. For most here, EBITDA is important. For some, not really. And about a fifth of you aren't sure what I'm talking about. That was me a long time ago, sitting in a room. They're talking about EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, or amortization. Depreciation is for hard assets. Amortization is for intangible assets, but it's the same thing. You're just reducing the value of that asset over time. And it's a metric that is used to evaluate the performance of a company. It's an alternative to net income. And how they do this is they look at that net income and then they add back any interest you paid, tax, depreciation, amortization expenses. And why this is important, according to the finance people, it provides a clearer picture of the company's operating performance and its profitability from its core activities. And EBITDA is an easy way to do comparisons of profitability between companies. It's another shorthand for profitability. If you're in the same industry and you can look at EBITDA, it takes out differences in how the capital structures are set up in these companies. Maybe they have different tax rates or they depreciate assets on a different timeline or for a different basis. So it makes things apples to apples when you look at EBITDA versus looking at things after EBITDA. Cash flow, it serves as a good indicator of its ability to generate cash. People want to generally buy a business that's going to be making money from its operations. It's a valuation, right? If you're looking to buy a company or sell a company, you can look at EBITDA or multiples of EBITDA as a way to set the price. Ironically, it is not a GAAP measure. So when people are talking about EBITDA, it is not something that falls under GAAP, though it is probably one of the most common financial metrics that I think are used by companies and by analysts and investors to look at the value of a company. Megacorp has the following financial results. They have $5 million in net income. They paid $1 million in interest, taxes, depreciation expenses, and amortization. To get to EBITDA, you take that net income and then you pull all the rest of that back up. So that interest, tax expense, depreciation, amortization, do some simple math. There's EBITDA of $12 million. And that will give you, if you're looking at this company again from an EBITDA basis, it'll give you the number to use to do the comparison or the multiples, or whatever the case is. All of the companies that I was part of, EBITDA was probably the single most important measure that we talked about. So understanding it, or at least knowing what it is, why it's important to your company, you may have to go ask someone, what are we doing with this? And I'd go asking people, what does this mean? Why is it important to our company? How should I be thinking about this? And not being afraid to look, I don't know something, because I don't know everything. And I certainly don't know a lot about, I didn't know a lot about numbers when I started as an in-house lawyer, And I think you'll probably be hard pressed to find someone who won't spend some time with you saying, this is why it's important, Sterling. This is how we measure it. These are the components that we're looking at. This is why it's important. You have probably heard this term, above the line and below the line. I, again, had no idea what this meant when I started, but it's a way of classifying items on the income statement as operating or non-operating activities. And I can remember sitting in meetings and people are going on and on about, is this going to be above the line or below the line? And now what they're talking about is, if it's above the line, is this directly related to the core operating activities of the business? Is this revenues, operating expenses? And below the line, is this below the line? It means it's not directly related. It's something that obviously is going on. We're getting money from interest. That's not really what we do. We're not an investment house. We're making widgets. but that's money coming in. That's going to be viewed as below the line. Gains and losses from investments, taxes, deferred taxes, and those extraordinary infrequent gains or losses, I would argue, and I did argue, that in antitrust litigation should be treated as below the line. So let's have an example of that. Here's XYZ Corp. You can see at the top, sales revenue, cost of goods, gross profit. The above the line items are its SG&A, so it's expenses, research and development, operating income, and then when you're looking at below the line, interest expense, income tax, etc. So the analysis is items 1 through 6, and they're numbered, are considered above the line because they're directly related to the core operations of the business. 7 through 11 are non-core, which are accounted for after calculating operating income. So again, operating income, net income, these are terms that your finance team and your C-suite are using to do different valuations and take different looks at how the company is doing financially. There are a ton of financial metrics and ratios and formulas that these different numbers plug into. In the appendix, I put probably 6 or 7 of the most important. And so they'll find these different numbers, operating income, net income, whatever the case is, and they'll plug those in. And that just gives you different ways of looking at the business in terms of how successful it is or how successful even a particular product is. Because sometimes you'll be looking at what is the profitability of a particular product. Should we stop making it, or should we go all in and make more of it? So why is this important? Above the line items give you insight into how the company is operating as a core business. Overall profitability, right? The below the line items highlight the impact of just how we're structured, non-operational activities. If you take those out, how are we really doing? So if you just look at all the numbers of the company all added together, you might go, wow, we're really rocking. Then when you look at it from what are we making from the operations of the company versus all this other kind of extraneous stuff, yeah, we have a lot of stuff that's above the line. Again, it all goes into management, decision making, and financial analytics for the company. But that's what they're trying to get to with above the line and below the line. Revenue recognition. If you work at a company that has a sales team, especially if you have SaaS contracts, revenue recognition is something that if you haven't dealt with, you will, because this determines when the company will recognize the revenue from that sale, and it's guided by GAAP. So there are 5 things that go into whether or not you can recognize revenue. First, there's a contract in place, right, between the parties that's enforceable. You can identify what the performance obligations are, right? What are the services or whatever's being provided? It could be consulting hours, it could be widgets, it could be maintenance services, whatever that is, that has to be identified. What is the price? What's the amount that the buyer is paying for those performance obligations? Each obligation will have some impact on how the revenue is recognized. I'm going to give you an example of that in just a second. And when are the obligations satisfied? Meaning, when did I do what I'm supposed to do that I can claim that now the customer has to pay me for the services and the goods? That sounds all kind of basic, but it's actually pretty hard sometimes to figure out when you're going to recognize the revenue for a transaction. And I can remember lots of debates, some of them pretty hot, about when companies are going to recognize revenue, with the sales team pretty aggressive on when we should recognize it, and the finance team tending to be maybe more conservative about when we should actually recognize the revenue from that contract. The revenue, so if we look at a SaaS basis, the recognition principle says revenue should be realized when the goods being purchased have been delivered. So this is revenue recognition, not accrual accounting. Remember, we're talking about recognition here. Recognition for SaaS companies depends on the pricing structure. Are they billed one time? Are they billed monthly? Are they billed yearly? You have to keep in mind that cash isn't revenue. Cash is important, but the revenue that the company is recording doesn't depend on necessarily when the money comes in the door. but you don't count it as revenue until you have delivered the products. Or over the course of a year or multiple years, you don't get to recognize that cash until the obligations have been satisfied under the agreement. It just sits in the company's accounts as deferred revenue. And you have to remember, if there's any type of refund or early termination with a refund of monies paid, that money's going to have to go back out the door if that gets triggered, especially if you haven't delivered the service. So it depends on the timing, right? Delivering the goods and receiving the payment for the goods. And if I'm a SaaS company, I'm using SaaS because it's a little easier to do the demonstration. A lot of SaaS companies are subscription-based businesses, so they may pay up front. Usually it's over the course of a year. It could be multiple years. And the service is delivered over that period of time. And so the revenue is recognized over that period of time. So let's say there was a $20,000 sale. I'm booking the sale in January. So I have a booking for 20,000. Booking is actually its own term in the SaaS world. But the revenue that I'm recognizing, if I am providing that service over 12 months, I can only recognize 1/12 of the time. So they pay me in January, they're using it in January, I get that portion that I could recognize in January, and my aggregated revenue is the amount that I've recognized. And you see the recognized revenue just stays the same because it's $20,000 divided by 12. The aggregated revenue, the revenue that I'm earning over the course of the year, goes all the way up until at the end it's $20,000. So you don't get to recognize $20,000 worth of revenue with a contract that has to be performed over the course of an entire year. Now, that's different than software that is on premise, meaning you have sold the software to the client, they're going to load it on their own servers or their own system. You got the money, they got the product. There's nothing else that has to be done. You get to collect the entire payment and recognize it in January. So for a $10,000 booking, you get $10,000 cash. You've given them the software, your obligations are over. So it's a little bit different when you're looking at that type of sale versus SaaS, because here again, the same kind of look at a SaaS, that same $10,000, but again, it's going to be performed over the course of the year. If you sign the contract in the middle of the month, you only get to recognize half the revenue, that half of that for that month, and then the rest of it on a going forward basis. And this is very complex because there are lots of fights about when we are providing the service and can the customer get a refund? And if they can get a refund, how much of that can you claim in a certain period? And as the legal team, the way that I saw this as general counsel is we would have a lot of discussions with the finance team and the sales team. How do we want to draft this agreement in a way that allows the company to recognize the revenue in the time period that it wants to recognize the revenue while staying compliant with GAAP and whatever the other accounting rules. And as the scriveners of the agreements, understanding what the company's position is on revenue recognition, why it matters, what you're trying to do is going to help you when you're drafting contracts or dealing with upset salespeople or unhappy finance people, because you're in the middle there, depending on how that's going to get worked out between those two groups. Okay, let's do our last poll here. We have just a few more minutes. Then we'll open it up for questions. We'll give away a book. So in this poll, have you ever set a litigation reserve? Yes, no, stop asking me questions I don't know the answer to.
I like that that was an option.
Yes, it's about half and half. That's really interesting. So setting reserves is another one of those financial tasks that you don't really know about. They don't teach you about this in law school. No one really tells you about this until one day the finance team comes to you and says, do we have to set any reserves for litigation? And then you go, I have no idea what you're talking about. There is a rule, an accounting rule. It's called ASC 450. It used to be called FAS 5. That's how I learned it. And what this says, if there is litigation or a dispute, maybe it doesn't have to be in court, but there's a material dispute, and the likelihood of losing is probable, put that in quotes for a reason, and the amount the company would have to pay can be reasonably estimated, you have to disclose that in the footnotes of your public filings, which feels strange, right? You've got to say there's a chance we're going to lose this litigation and we set a reserve for $1 million. And this can be one of those things that's really painful for lawyers in the legal department. And there's a lot of gray in this. What does probable mean? It's defined as likely to occur. Oh, thank you, finance nerds. That's really helpful. With litigation, if you've ever dealt with litigation, it's extremely hard to predict. My rule of thumb was always I had to believe, consulting with my outside counsel, that there was a 75% chance of it occurring. If we felt 75% certain, then it was probable. Estimating payout is another problem because if you look at a lot of lawsuits, especially when they come in the door, either there's no claim for damages, it's just we've met the jurisdictional threshold, federal court, that's $75,000, or they ask for a gajillion billion $1 million and they're never going to get that. So what do you use? And for me, unless the expert witnesses had weighed in on what the damage model is and we felt 75% certain, I would not set a reserve. I just said, we haven't met the test. We're not going to set it. And that could drive a little bit of tension between the finance team or even the outside auditors. But if you can explain why you are thinking that way, then generally they will defer to the legal department's judgment. It's a task you may have to do. There are some resources here. I was always concerned about, doesn't this waive the attorney-client privilege if I'm giving my legal opinion to an outside auditor about this case? What I've been told, what I believe the right answer is, it may not be privilege, but it's work product. So because it's necessary, it's part of litigation, part of deciding some part of the litigation. But at some point over the course of your legal career, you may be asked to set a reserve. Okay, so that's about all the time we have. There's a lot more we could go through, but when you want to tie it all together, really what we're talking about when you talk about these numbers is financial analysis, which is how is the company doing? There are materials in the appendix. The things that the company does with all the bits and pieces that we've just discussed, they make investment decisions, performance evaluation, strategic planning, forecasting, considering mergers and acquisitions, what prices do we need to set? All of these things are really important. And you can see as a lawyer, if you want to be a strategic advisor, if you want to be someone who is thinking about things more than just the legal question, understanding or getting comfortable with the financial numbers will allow you to be part of these discussions. And these are the discussions that they're having in the C-suite, they're having at the boardroom. And if you're not tuned into this, again, you're a tourist, right? They're speaking a language you don't understand. You're just waiting for someone to say legal issue and then weigh in. So it is really important. Again, there's some resources here that I think you will find particularly useful. Here are some links to things that will help if you want to go deeper on this. A really great thing you can do, it's pricey, but the ACC has a mini MBA course for lawyers. If you can afford the time and afford the tuition, that's a really great thing to do. I mentioned YouTube, lots of information on YouTube. If I had to have one book, and I own this book, you might remember these nutshells from law school. This is one that will walk you through accounting and finance, probably giving you far better descriptions of the concepts that we just walked through. And I would bookmark Investopedia, all the things that we've talked about, all the things in the appendix. You can look up here. They have great glossaries, great explanations. They have videos here that will walk you through a lot of these concepts and give you demonstrations. So if you're interested in learning more or if something comes up and you want to learn about it, this is a great place to start with that. And with that, I'm going to stop, Shai. We're going to give away a book. So over to you.
All right, so we're going to get to questions, Kate. So first of all, thank you, Sterling. Thank you, Kate. Thank you, everybody, for a wonderful session. Okay, is there any theme, Sterling? First of all, tell us about this book. What is this book all about?
How to get more stuff done. So one of the things I got asked a lot about, or do get asked a lot about, is how do you get so many things done? Like, how can you write books and write a blog and be a CEO and all those other things? And I have a lot of things that I had learned over time And I decided I wanted to capture those in a book. I thought it would be really short. It actually has turned out to be about 400 pages, which is pretty long. I would say the irony of writing a book on productivity is finding the time to do it. But every trick, everything that I know about how to be more productive, I have put into this book. And I think anyone who reads it or buys it or gets it today, there are lots of things in there that you can put into practice and you will find yourself being able to do more in less time. Having sat in the chair, it's really focuses in on the things you will face day to day as an in-house lawyer.
Okay, awesome.
First off, someone asked if the book will be an autographed copy. So I think that's an important question
I
to
will. I may not know numbers, but I can sign my name. Yes.
Fantastic. We also had a request for us to host you to talk about your cookbook, so we'll have to put that one on the
We could do a
books.
cooking demo.
That'll be great. Yes, we'll put you in your kitchen and we'll cook through it together. I think
Die
that'd
up to
be
you, man. We'll do
perfect.
it.
Okay, so one of the questions that we had in the chat was, can you explain again why you would want to look at EBITDA, EBITDA, am I saying that right? When
Yeah,
considering
EBITDA, yeah, they're all the
EBITDA,
same.
okay, when considering buying a business.
Because it shows it's a shorthand for profitability of the business. So if you know the EBITDA number, even though it may not be to the penny, the profitability, if you went through all the different bits and pieces that go into looking at gross profit, net profit, etc., it's a real shorthanded way of looking at it. And because you're eliminating a lot of things that are noise, so taxes, depreciation, interest payments, it gives you a way then of comparing a business that you want to buy maybe to other businesses that have sold recently or that are also for sale. If they've borrowed a lot of money or didn't, if I can take that out and I can just look at the EBITDA numbers for all of them, that kind of makes it an apples to apples comparison across the board. So it's an easy way of making things that aren't necessarily similar, and then I can make a better educated decision without having to really parse through a lot of detail, which they will do, but it gives me a shorthanded way and a quick way of looking at things that makes sense.
Great. I think that kind of also answers this other question, which is what is the value of measuring EBITDA?
So I was part of two companies where EBITDA was part of the bonus component for
Oh,
employees. So we had an EBITDA target. If we met the EBITDA target, everybody, yay, bonuses. If you didn't meet it, boo, no bonuses. So that's another reason why it's important to measure it, depending on
yeah.
what your company might tie it to.
Got it. All right. And then someone asked, is severance payment below the line?
If you're doing a mass layoff, yes, because it's an extraordinary event. If you're just doing onesies and twosies, then I think it just goes into general expenses of the company. At least that's how I understand it.
Got it. All right. And then is there a minimum payout amount that the FAS 5 requirement applies to?
Can you say that again?
Is there a minimum payout amount that the FAS 5 requirement applies to?
Oh, no, there isn't. But I think if you're reporting on it in your annual report, it has to be materiality for publicly traded companies in terms of reporting isn't enough to change the behavior of the average investor. If someone sued me for $10,000 and there's a 75% chance we're going to lose, no one's going to care about the $10,000. If it's a $10 million case and I feel there's a 75% chance we're going to lose, now I'm going to have to set a reserve for that and report it because it's material. Technically, there's not, but there is a materiality part of reporting publicly. So that's what you have to go by.
Got it. All right. And then the last, I think, substantial question we have here is in the accrual accounting basis, what happens when the revenue doesn't come in? Where is that delta between expected revenue and actual revenue covered?
It would probably be an accounts receivable, which is going to sit in an asset on the balance sheet. So I think that's where you're going to see it. But because it's money that's owed, but then there are measures of your aging receivables. And as that aging receivable, if someone is trying to invest in the business or the board is looking at the performance of the company and they go, your accounts receivable have aged from, they used to be, you were getting paid most of them in 45 days. Now it's 90. What's going on? And if it's taking 90 days to get the cash in, can the company keep going? Because you're probably going to have to borrow money to make payroll, to pay bills until that cash comes in. So it's an early warning as well. I think it's in accounts receivable and it sits on the balance sheet as an asset because it's money owed to the business. And if I'm wrong, someone who knows more about this, jump in on the chat and go,
Someone actually
you're
is.
so full of crap, Sterling. That's not it.
So, what
Okay.
is the company required to file if it is determined that the company failed to report litigation or a material dispute under ASC 450?
Okay. If you have failed to make a disclosure that you think you need to make a disclosure, so you missed your quarterly reports, you're going to have to do what's called an 8K, which is when you report on something material outside of the normal reporting periods, which is never great because especially if you're saying we missed, we goofed, and this should have been reported in the quarterly or the annual, whatever the report is. So it's probably why, at least when I was GC at the publicly traded company, we went through every piece of litigation. We did the analysis with the finance team and the outside auditors, sometimes with our outside counsel, because you don't want to have to report something as being missed, especially when that could drive the stock down. Because if you've worked for a publicly traded company and the stock drops, guess what happens tomorrow? A bunch of people start suing you for failing to disclose properly. So there's a lot of pressure. I've never seen that happen. There is some judgment on it, right? So if it's not 75%, maybe you go, you know what, 74, so I'm not going to report it. There's still a chance that if you do report it at some point, someone would still say you should have reported it earlier, and you'll have to have that fight. So again, there's a lot of judgment. How close to the line is the CFO willing to play it before you report that reserve? Because once you set a reserve, that money is now unavailable to the company to do anything with. You can't invest it. You can't pay bills with it. It just sits there until the matter is resolved. So it's a way of tying up money that no one really wants to see.
I know we have one more question, but they can reach out to Sterling directly. So first of all, Sterling, we have over 100, nearly 150 people have entered this random drawing for this.
Okay, fantastic.
Is it possible to, only one winner, is it possible to offer like a coupon code or something for the others to purchase it?
I can't because the ABA controls the pricing, and you know what bastards they are. I wish I could. Every once in a while, they'll do offers like that, but unfortunately, if I could, I would. Put it that way. If I could, I would.
All right.
But I tell you what, Shai,
Yeah.
let's do 2 books.
All right. All right. All
2
right.
winners.
All right.
ABA be damned.
Awesome. Awesome. That is what I want.
We'll do one more book.
All right. So the first winner, I am looking at them. They're still here. It is Madeline Sant. Type in the chat. Let us know you're alive and that you're paying attention. Madeline Sant. You're from Human Interest from Salt Lake. There you are. Woo-hoo.
There we go.
All right.
All right.
Congratulations.
Madeline.
All
You're
right.
welcome.
I'm sending this. All right. So Madeline Sant, congratulations. Can we get a drum roll for the second one?
Extra special bonus book.
Extra special bonus. All
There
right.
it is. That's invisible. Isn't that cool? How does that do that?
Ooh. I know it makes my ponytail invisible, keeping because I look like I just have a bowl cut.
There's a
right.
Drum roll.
Let's
There we
roll.
go.
The second book is going to Carrie Schatz of Texas. They are at Trans-America.
Right here in the Dallas area. Fantastic.
That's right.
Carrie,
are you there? Are you there? Tell us you're alive, Carrie, in the chat.
hope you're not in the bathroom. There we go.
Awesome.
Fantastic.
Awesome. This was a lot of fun. Thank you so much, Sterling, for doing a second one. And thank you to everybody who tuned in and participated in this drawing. We have more stuff to give away. We will definitely make that happen. And sorry to the other 150 people, but this was great. And hopefully next time, tune in for the next Sterling
webinar. We'll do it again. And maybe we'll have the second cookbook to give away next time.
We're going to make a cooking class happen, Sterling.
All right. We'll make it work. I can do it.
All right.
I do one every year for our ladies, women lawyers group inside the firm. Every December, we do a cooking demonstration from the book. So I can certainly do it. Thanks, everyone, for sticking around. Appreciate it. I love In-House Connect. Get out to the live meetings. If you're in Chicago, then Seattle's coming, right? Get out. meet Shy, meet Kate, meet other in-house lawyers. It can only be good.
Love it. All right. Thank you. Great job, everybody. Great job, Kate. Thank you, everybody, for tuning in. Have a wonderful Tuesday. We'll be back tomorrow with more. And until then, have a great day. Take care,
All
everybody.
right. Hey,
Thank
bye
you.
now.